In this video, I want to share my updated Lemonade model and explain why Lemonade has so much potential.
I have to say, I am so impressed with the potential you see in me. Yeah.
Let's dive into it. So I've updated my Lemonade model since their recent earnings. And just I want to mention, this entire model is available on my Patreon. So if you want to support the channel, you want to get access to this model as it's updated, feel free to join my Patreon, check it out. So the biggest changes I've made for my model is that in the next few years, I've slowed down their growth and also cut back their expenses. This is in line with what management said in their recent earnings report that said, they've moderated our growth spend and hiring pace and expect our existing capital to suffice until we're profitable. So I'm basically trying to make my model work so that they do not have to do a capital raise. How would that work? How would that look? That's what we're going to look at here in the model here today. But still, huge upside if you look far out by 2030, by 2035. I'm actually in a similar place as I was in my previous version of the model that I unveiled. But currently in this version, my most up-to-date version of the model, if you look out to say the end of 2024 at their in-force premium, I'm at about 1.8 billion. Previous model, I was at about 3.2 billion in-force premium by that time. And this 1.8 billion on my current model was at a premium per customer of just under $700. The old model, I was at $876 premium per customer and 3.7 million customers. At the end of 2024, now I'm at 2.6 million and $695 per customer. So again, just slower growth in the next few years. But looking out at the bigger picture, if I go all the way out to 2035, I'm still at a similar in-force premium of $112 billion. 78 million customers and around $1,400 in premium per customer. And if I look at my previous model, very similar, 78 million, 1,400 and 114 billion in-force premium. A couple other changes I want to point out in my model is that I actually have the gross loss ratio dropping down to 75% and then actually going below 75% all the way down to 68% kind of in the long-term limit. And why is it below 75%, you might wonder? Given that they have a give back program that takes 25% as administration and profit and then 75% in paying out claims. Well, actually, if you look at the details of the give back, they do say they give back your unclaimed money. So if you're part of a group that chooses a charity and there's unclaimed leftover money after paying out the claims from your group, then will give back that unclaimed money up to 40% to the nonprofit you choose. So you actually could have gross loss ratios below that 75% mark. Other thing to note is I have the annual dollar retention actually increasing to over 100%. This is just based on the amount of churn I'm seeing or expect to have. I expect the churn to slowly decelerate as the customer base grows bigger and bigger and as more products are offered in more places. And I expect the churn to slowly decrease down. I have that decreasing eventually down to 17% per year overall, and that means the annual dollar retention. Actually, when CAGR is ramping up and then the premium per customer is ramping up, annual dollar retention I think will go above or could go above 100%. And I've added into my model here a number of graphs that I think are going to help visualize the current model a lot better, a lot more clearly. So the in-force premium over time, really you have an exponential graph cruising upwards as you have the number of customers growing at a bit of an exponential and the premium per customer at least growing at an S curve and then tapering off over time. You have this really accelerating upwards. So I have the number of customers, again, following a similar pattern. I believe that Lemonade, if they become profitable, is going to aggressively grow internationally. I just tweeted about this today. If you look at their founder's letter on their investor relations page, they said, we believe we are short-term patient but long-term greedy and believe opportunities such as ours are rare and fleeting. And they go on, we aim to first grow fast and capture as much market share, mind share, and as large a geographic footprint as possible. And again, I've mentioned this before, but when I interviewed Daniel, I asked him, would you see Lemonade in Canada one day? Because I'm from Canada. And he said, really, of course we see ourselves in Canada, and actually just about any country in the world, if you ask me that question, we'd say, yes, of course we see ourselves there long term. So in my mind, that's Lemonade's path. If they become profitable, their customers are going to skyrocket as any available cash they are going to funnel into growing the customer base. Again, I tweeted about this today. I said, once Lemonade reaches profitability, I expect many decades of aggressive international growth, which is important for achieving a runaway data advantage, because the more customers they have, the better their underwriting could be, the better their fraud detection could be. They get those elements good enough, they could really have a runaway data situation where anyone who tries to copy exactly what they're doing is too far behind, too difficult for them to offer a good enough value proposition to the existing or the current customers, and they could really leave the competition behind. And I followed this up. I said, growth will only be constrained by regulatory requirements, how quickly they can roll out new products in new places, and the cash reserve requirements. Jumping back to my model, again, I believe the number of customers, even looking past 2035, because we're only at 78 million customers here, there's a lot more insurance customers than that in the world. This number, I think, could go significantly higher before this turned into an S curve and tapered off. Now I'm going to jump over to premium per customer. My premium per customer, I kind of have more of an S curve that's still slowly crawling upwards, but it's going to accelerate up here in the next few years as more more products are rolled out to their existing customer base, and then eventually starts to sort of slow down the acceleration as they continue to expand internationally and have more and more new younger customers joining their ranks. But existing customers also continue to get older and buy more and more products. These numbers crawl further and further up. Jumping over to operating income, you're down in the negatives until around 2025. Somewhere in 2025 is likely where they're going to have their first positive operating income, and then it could really accelerate off from there. Looking at the potential market cap, if you're looking at a PE ratio or just a price to sales ratio, you could have a range somewhere in this range, accelerating out into the 2030, maybe by 2030 they're at about a 50 to $100 billion market cap. So maybe, you're doing a 25 to 50x by 2030 if they're successful. And then even beyond that to 2035, the end of 2035, I have about the $230 billion range all the way to a $500 billion market cap range. And flipping back to the model, that's calculated with a price to sales or price to in-force premium ratio of about 2.1 actually I have it at 2035, and a PE based on their annualized profit of about 40. So, some people might say, wow, that's way too high for an insurance company, 40, but it's really only a PEG or PEG ratio of 1.19, which is actually quite low. So I think even conceivably 40 might be too low, and this could be higher than even what we're seeing here right now. Because they're not going to value this like a traditional insurance company is valued today. They're going to be valuing it like a company that is growing their top line in-force premium still, in a 30-some% year-over-year growth range. Now, if we look at a graph of expenses relative to the gross earned premium, so you can kind of see in the past here how expenses have been fluctuating. This blue line is your total expenses, and then you have your sales and marketing, tech development, other insurance expense, and general and administrative expenses, all relative, all as a percentage of gross earned premium. You can see where they have come down and they are kind of leveling off. And then I have these really descending down into, by 2030, you're at 16%. By 2035, maybe you're at 13% total expenses relative to your sales. Cash position, again, is going to stay pretty level here and then accelerate in later this decade. And then this one is interesting. This is your cash requirements, the difference between the cash they need to hold based on the amount of premium they're writing and based on how their reinsurance is structured. And the difference between how much cash they have and how much cash they need to have. So I actually have in my model, if they don't raise any capital, as they suggested in their last earnings report, I actually have this difference slowly dropping as they're rolling out their product lineup, as expenses are dropping down. Then this difference is still lowering because their in-force premium still is gaining and their cash is still lowering until around the 2025 mark. So what I'm expecting is somewhere here where you can see this little step change, is that I think they're actually going to increase their reinsurance. So they've dropped their reinsurance. It was about 72% reinsurance. They've dropped it down to 55% reinsurance. And I think that is going to help them be more fiscally conservative over the next few years, trying to save and to save a little bit more money and diminish their losses. But at some point here, if they don't raise any money, I think they're going to actually increase their reinsurance so that the amount of cash they need to hold relative to their in-force premium is less. And I tweeted about this to Daniel Schreiber. I said, hey, Daniel Schreiber, if reinsurance is at 55%, approximately what factor of in-force premium to surplus capital will you need to hold? Would be great if you could touch on this in the call. Didn't touch on it in the call, but he answered it here directly on Twitter, which was great. He said, surplus levels are governed by the risk-based capital formula, though as a rough and ready rule of thumb, insurers need to hold reserves at the rate of 3-to-1 on the net and 8-to-1 on the gross. So I've used that rule of thumb and use that 3-to-1 ratio of the in-force premium to the amount of cash they need to have in reserve. But then here I jump the reinsurance back up to 72%. It becomes more of a 1-to-7 ratio. And you see that here in my model at Q4 2024, I've upped the reinsurance back to 72%. And I've continued that reinsurance at 72% all the way through until we get to Q3 of 2023. I've dropped it back down to 55% and then have carried that through. And if I jump back to the cash requirement graph, then you see this major step change as you go from that 72% with a 1-to-7 ratio, boom, down suddenly to a 1-to-3 ratio with the 55% reinsurance. Of course, better long term, if they don't need the reinsurance, they'll actually become more profitable, and these profits will accelerate even faster and then even beyond into the future years past this if they don't have the reinsurance. So long term, I expect the amount of reinsurance will slowly drop, but I do expect if they don't raise money that they will increase their reinsurance here. And if I change all my reinsurance all the way through to 55%, I'll do that as a quick thought experiment. Then you'll see that this cash requirement, you run into problems pretty quickly here.
More money, more problems.
So they're not quite yet profitable yet. And the rate that the in-force premium is growing, their need for the capital reserve is growing faster than the capital they are building. And then you're going to run into problems. So at this point, they'll need to either do a capital raise before then, which I think if the stock really, flies between now and 2024, I could see them doing a big capital raise and then maybe continuing the growth rates sooner, and you pull some of these future years forward a little bit. And just out of curiosity, how much would they need to raise if they did a capital raise to never have to capital raise again? Maybe somewhere in the $1.5 billion range. And if I jump over to my model and look at 2024, 2025, look at their cash on hand and say add another 1.5 billion to the cash there, then you can jump back to your cash requirements and see that you're entirely positive all the way throughout. So that would be the other situation, but I think that's only going to happen if they can raise money at an attractive price. So I hope you guys enjoyed this, and I'm making it clear to you that Lemonade is structured in such a way that if they are successful, the upside is so much bigger than I think people realize. And even this, 200, 300, 400, $500 billion range, I don't think that's the end. They would keep growing. And I think even, $1 trillion, maybe even more than that in market cap is one day conceivable. Certainly is conceivable to me, just based on how the company is structured and how they really could create a runaway data advantage where it's difficult for even competitors or people trying to follow them to catch up to where they would be at or could be at. Again, if you joined this, also make sure to check out my Patreon and get full access to this model. And most of all, remember, it's in the bag.